I think we'll just go ahead and get started now. It's just a few minutes after noon, and again, you've reached the CFMA Lunch and Learn. Happy you're here and happy we can present to you today. Today's topic is navigating the gray PPP, so the Payroll Protection Loan Program, making the most of forgiveness. I think Sanel's going to take just a few minutes here kind of to cover some items and maybe make some announcements before we kick off the presentation. With that, Sanela?
Yes, thank you, Kevin. Good afternoon, everyone. We're going to go ahead and get started. I want to welcome everyone to CFMA Houston June webinar. My name is Sanela Majnik. I'm the president of the Houston chapter for this fiscal year. I hope everyone's doing well during these unusual times. The Houston chapter very much appreciates the support of all our annual sponsors during these unprecedented times, which is why, I asked our friends at Briggs & Veselka to display a list of our sponsors while I'm talking. The sponsorship program enables us to enhance the quality of our events, offer better value to our members, and provide valuable recognition to participating companies. I would also like to take a few minutes to update everyone on the state of the chapter and upcoming chapter events. We're in the midst of the membership renewal process. If you haven't had a chance to renew your membership, I encourage you to do so. I know many of you participated in our membership drive, which ended April 30th. The winners of two $500 gift cards will be announced at our August 26th event. Speaking of the August 26th event, this will be our first live event, hopefully. Our chapter is celebrating the 35th anniversary on August 26th. The guest speaker will be a renowned economist, Anirban Basu. Anirban was originally scheduled to be our speaker at the economic update in March, but due to the circumstances, we had to cancel that event, and we're very happy that he will be able to join us for our special 35th anniversary. We'll recognize our long-term members and look back on how our chapter has evolved over the last 35 years. This will also be a dinner event and will take place at the beautiful Briar Club. So we hope that a lot of you will be able to attend. Obviously, we will ensure some social distancing and make some modifications to be able to do that. Now, prior to our August event, we are planning on having two webinars in July that will provide CP credits to our members, and we will be announcing those dates soon. On September 23rd, we will have luncheon with our with the founder of Abacus Plumbing, Alan O'Neill, and that event will be held at Sheraton Brook Hollow. Now, our annual golf event will be held on October 21st at Golf Club of Houston. I'm also particularly excited about our November event. That event will take place on Veterans Day, which is November 11th, at Hilton Post Oak. The guest speaker for this event will be a distinguished veteran, Commander Kirk Lippold. Commander Lippold is a former U.S. Navy officer who was also the commanding officer of the Navy destroyer USS Cole on October 12, 2000, when the ship was attacked and bombed by Al-Qaeda terrorists in Yemen. Now, some of you remember that story. I do, and I was following the news when that happened. Commander Lippold is now retired. But he's a very reputable speaker, and he will talk to us about the leadership in crisis. And now I would like to thank Briggs & Veselka CPAs for hosting this event. We are very excited to be able to offer this event to our members. It is my pleasure to introduce our speakers, Kevin Stewart and Jane Kelly. Kevin is an accounting executive with 20 years experience turning around and building strong accounting and finance teams. Kevin's deep finance and accounting compliance expertise helps executive teams with the development of operational strategies by increasing integrity of finance functions, enhancing the management's understanding of operating results, and improving the quality of financial information. Most recently, Kevin has served as a small business administrator task force leader of the firm. He's serving as a subject matter expert on SBA CARES Act initiatives, providing guidance to internal and external clients, along with delivering webcasts to clients, banks, and others in the community of loans, forgiveness, and best practices. Jenna has 8+ years of experience providing tax and accounting advisory services to her clients. She specializes in providing accounting services and tax planning and preparation services. Most recently, Jenna has served as a critical member of the Small Business Administration Task Force. Jenna has also worked directly with clients and bankers in order to actively address their questions about CARES Act, PPP loans, and forgiveness. Now, before I turn it over to our speakers, I do want to tell you that there will be poll questions issued throughout the presentation to qualify for CPE. Kevin, Jenna.
Thank you so much, Sanella. We're excited to be presenting today. We've presented probably, I'm going to say 18 to 24 times over the last several weeks to a combination of bankers, accountants, internal clients, prospects, everybody else you can imagine. Probably had hundreds of conversations across the board with clients who have interest and prospects who have an interest in this, and specifically recently around forgiveness. And there's a lot of gray areas that have required a lot of research and consideration. A lot of things have changed in the last since the program was initially issued. So we're going to try to walk through some of those things. John and Kelly is an advisor manager that we work together quite a bit on this. And so hopefully this goes well and it's useful for you. With that, our three key learning objectives that we want to cover today is truly understanding what qualifies as forgivable. And then separately, the gray areas, and we've highlighted 4 or 5 areas that we believe are a little bit gray areas, which require just a little bit more guidance from the Treasury or SBA. And then lastly, best practices around expense tracking, documentation, and just preparing a very clean forgiveness package. So with that, when all of this began, these are all of the programs or potential pieces of programs that was a response by our U.S. Congress and government, and kind of to address the need of COVID-19 and the impact that that's had on all of us. You know, in addition to COVID-19, that's kind of impacted oil and gas prices. It's impacted usage. And so there's been some unexpected or maybe non-specific COVID-19 impacts to other areas of the economy by which, you know, the government's tried to address and try to stimulate some things. And so with this, we have this matrix or this beehive, effectively, honeycomb of acts that have been addressed. And today we're really talking about the PPP and then most recently, the PPP Flexibility Act. I mostly just show this slide out here to show, I'll call it the complexity of the legislation that's been created. And even things that should be intended to be relatively simple, when you add kind of the breadth of items to it and the things to take in consideration, there's a lot to evaluate as a business owner. And then separately as John and myself as accountants and advisors to clients, it's a lot to become an expert in. And hopefully we've done that and we can prove that out today a little bit. So kind of on that note, it's been an ever evolving process. You know, when the SBA and Treasury Department, they're really providing the interpretation of the legislation created by the U.S. Congress and President Trump's signature. But with that, you know, some of the intended consequences or some of the intended legislation got, I would say, a little bit skewed in the way that the SBA and or Treasury interpreted it. And they're just, again, they're kind of doing the best of their ability interpreting. But in some of the town halls with Senator Rubio and some other congressmen, really the goal of the act was to get basically dollars into employers' hands, right? So the way to do that was through wasn't intended to be a loan, but the way to do it was by doing a loan. And so with that, there's been a little bit of complexity in getting there. And so some of the interpretation wasn't really the intent. And so there's been some clarifications and continue to be clarifications on that. So I say that, and that it's an ever evolving process. And what we know today, by God, it may change tomorrow. So, we're continuing to look for updates. We're continuing to look for interpretations of what they presented. Excuse me. So understanding there's an alternative covered period, so when the initial came out, the guidance allowed for an 8-week period. And so there was conversation around, is that 8-week period, does it start on the day of disbursement? Does it allow for accrual methodology? Is it truly cash basis methodology? So the interpretation that came out about 2 weeks ago with the application for forgiveness was it gave a little bit more clarity on that specifically. So it is as of the loan disbursement date. That is when the 8-week period begins. But there's an alternative period there as well related to, it's maybe the first pay period after the disbursement date. And so there's a little bit of interpretation there and maybe with the new guidance come out with the Flexibility Act, which we'll address in a few minutes, that potentially goes away a little bit, right? Because you have a longer period that we'll address in just a few minutes. And I will say, John, if you find at any point in time you want to clarify anything that I misspeak, please do so. I know we'll be bouncing back and forth here, but please add in. All right.
Will do.
Forgivable payroll costs. The total eligible payroll cost incurred or paid, and I think that is important. The initial reading of the guidance was, it seemed to be very cash basis. Now, my interpretation of it was different because I believe the intent was really, they're just trying to cover an 8-week period. Whether that be the specific 8 weeks of that covered period, or whether it be a payroll period that covers 8 weeks in that similar time frame, a week, give or take a week. I think there was some interpretation there, but the very strict reading of it was cash basis. So when they came out 2 weeks ago, there was clarity there. So is payroll costs considered or paid on the day that paychecks are distributed? And so there's a give and take before and after the payroll period. Got to answer my poll question, or everyone else do the same. I can't vote. There we go. So it's really about incurrence, and it's really the interpretation or the intent of the law is to cover that 8-week period.
Yeah, and just to jump in on this, Kevin, that was probably the area where we had the most questions, but as you said, we were really trying to tap into the intention of the act as originally, what the goal was, which was to cover payroll. And so I think that this Flexibility Act that you're going to talk about in a minute will really illustrate how they answered that question.
And honestly, with that, there became a lot of questions of how do you, my grandfather used to say monkey around. So how do you monkey around with your payroll to get it to be most beneficial to you? I think some of that goes away because of the clarity here that's provided. So on the forgiveness adjustment, the forgiveness is based on really two pieces. Like it's what did you spend it on, first of all, right? So did you spend it on payroll? Did you spend it on those qualified items of mortgage interest, et cetera? But on the payroll portion of it, it's a combination of the amount of payroll that you spent in comparison to a prior period, which we'll cover here in just a minute. But the second piece of it is, did you maintain FTEs, meaning full-time equivalents? And what does that really mean? Again, a few weeks ago, that clarity came. It's a 40-hour work week. But what they're allowing for is really two different approaches. And one of the approaches is just for each employee, you're entering the average number of hours paid per week and divide by 40, right? And so that may or may not be beneficial to you. And then the second one is you assign one for employees with at least 40 hours and then half for employees with less than. And so you can see there on the schedule below that there could be a more beneficial method to you based on the makeup of your employees, right? It may make sense to use one or the other. So I would recommend you calculate both and then determine which one is best for you, which is most advantageous. From a safe harbors perspective, and we do have, this did change a little bit. Originally the safe harbor on the initial 8 weeks was as of April 26th, meaning that if you had to do a layoff and you had to cut some employees, if you brought those employees back by June 30th or not later than, because sometimes that 8-week period was before June 30th. If it's not later than June 30th, then you got grace. You got a safe harbor. Well, that has now changed to be there's an option to move that to December 31st, and we'll see a little bit of gray here in a little bit. Again, it's the same concept. It's as long as you've hired back your same level of employees or a portion of the same level of employees, depending on the level of forgiveness you're getting. It's not later than. I think that not later than is critical, but there's also room for interpretation there, as we'll see in just a minute. And from a comparison period, that comparison period is February 15th to April 26th. I think some things we see it's Q1, but truly there is a specific date and time period there. Johnny, you want to walk through this one? Do you mind?
Sure, not at all. So in addition to looking at the number of full-time equivalent employees you have, you also need to take some time to look at the changes in salaries and wages provided to your employees. So it's not enough, based on the way the Act is written, it's not enough to spend 75% on payroll and 25% or 60-40, depending on which option that the Flexibility Act now added that you choose. But on top of that, you need to keep the same number of full-time equivalents, as Kevin's already discussed, and you can't reduce salaries and wages below 75% of what they were before. You're going to do the same type of calculation where you'll take a look at the covered period versus the comparison period that Kevin illustrated before, and just prove up whether that had any kind of change in the amount of salaries and wages. If there is a difference in full-time equivalent or salaries and wages, then even though all of the money is spent on the correct things, you'll have a reduction in what's forgivable. Again, the 24-week extension that the Flexibility Act adds should make some big changes in this area, but it's still a piece of the calculation that has to be considered.
Then we get to the non-payroll cost. And so when the initial calculation was performed, it was based on 2.5 times of the average payroll for 2019. Or if you're seasonal, there's a seasonal aspect there too as well that we're not going to discuss here. So that increased by that 0.5 or 0.25 on a monthly basis was really to identify and cover. Not every company is payroll intensive, and you still have real cost. And so there was an allowance for that. So those non-payroll costs that are paid or incurred, and I think that is again critically important, is around business mortgage interest payments. We still do need a little bit of guidance from the SBA on this, because when I think about a mortgage, I'm thinking about a house or a property, and really that it seems to be the way that it reads, it indicates that it's interest or on other debt obligations before February 15th. Again, that's an interpretation, but it's not black and white necessarily. It's just kind of an interpretation. Separately, it could be around business or rent lease payments, and that does lead to not just property, but it's also personal property as well to allow for. And again, those lease agreements need to be in place prior to 2/15/2020. And lastly, business utility payments on the non-payroll side. So it's electricity, gas, water, transportation. We've gotten a fair amount of questions on the transportation. What does that mean? We don't know, right? So that's kind of the answer. We've sought some guidance. We try to understand, but it's not really defined what transportation really means. We don't really believe that means rental cars or those types of things, or truck or gas for vehicles necessarily, but it's not really completely defined. So we do need a little bit more guidance on that.
Kevin, do you mind if I jump
Please.
in really quick?
Absolutely.
We've had a couple of questions that are really more related to the payroll and salary that I thought maybe we could quickly address. One is, if an employee's salary is reduced because of a demotion but they're paid more than $100,000, would that matter? You're still going to have that $100,000 limitation regardless of the length of the covered period. So you'll have to take whatever you pay each employee, annualize that, and make sure it's not over $100,000. And if it is, there'll be a reduction that you'll take in the amount of payroll costs that you'll include in that application. Also, I know that sometimes the hours question is difficult. So when you think about the hours that each employee works, and if you went to any original webinars maybe a month or two ago hosted by ourselves or others, there were definitely some questions about how many hours is full time, can we aggregate? And so what Kevin illustrated was that the application that came out a couple of weeks ago made it very clear Thank you. That the hours max out at 40. So if somebody works overtime and they're at 60 hours, they're still only going to count as one full-time equivalent employee for per pay period. So what they're working and what you're paying them for this calculation would not technically matter. Now, if they're working overtime and they get paid more, obviously that's going to increase the salaries and wages, and there's a different calculation going on there. But in terms of hours, 40 hours is full-time. Anything above that is still just full-time, still just counts as one. One last question, Kevin. Do job site trailers for on-site officing on projects count as rent? I guess the biggest question is, do you have a rental agreement in place prior to February 15th? Was definitely a piece that you'll have to provide in terms of documentation when you apply for forgiveness. Do you have anything to add on that one?
Well, I will say kind of going back to the payroll piece of it, when the application was filed to get to the 2.5 times, it was based on an individual level to a certain degree when it came to the 100,000. So when it comes to forgiveness, it's based on the individual level. It's not a collective. And so it does go back to the details, and the details do matter. It is an employee by employee basis. One other thing to add on that is if someone does, and I think we'll cover this a little bit, if somebody quits, if they retire, if they do those types of things that's outside of your control, it's just a matter of documentation. So the path to forgiveness here, and this is just I think a pretty simple, good chart, is the true-up period is coming. I think for some it's may have come, right, if they don't elect for the 24 weeks period versus the 8 weeks. But forgiveness isn't necessarily guaranteed. I will say when this whole process started, it appeared that banks were basically being given clearance to, you just got to issue the loans, right? And then it's going to be forgiven. And we're not going to hold you accountable, banks, as long as you do some due diligence. I would say that's turned a little bit based on updates from the Treasury, updates from Mr. Munchin, the Treasury Secretary, and some others, that there is a little bit more bite to the bank and to the borrowers as it relates to forgiveness. And so forgiveness is not necessarily guaranteed, but the forgiveness amount is expected to be decided after filing for an application. And so you got the maximum loan amount, and you take in consideration, what did you spend the money on, right? What were the qualified expenses? What were the non-qualified expenses? And was there any excess of funds? So if you kind of just go across, if they're qualified, you meet the criteria, it's eligible for forgiveness. If they're non-qualified expenses, if you spend on things that weren't payroll, if they weren't mortgage interest, those types of things, or if it's just excess potentially, then it's converted from potentially a 2 or 5 year loan amortizing at 1%. And then lastly, there's funds that you didn't use. In 2019, your payroll was high. You applied for it. You didn't have, maybe your payroll went down for whatever reason, right? Or it stayed the same. Maybe there's just excess funds. And so the question becomes, what do you do with it? Well, you either return it, or it terms out, and the term out really means it becomes a 2 to 5 year loan at that point, which you're paying on over the next 18 months or so. So as far as maximizing forgiveness, and we're getting ready to get in some gray areas here, it really becomes about ongoing expense monitoring. If you have audits on a regular basis, if you are being reviewed on a regular basis, really it's not significantly different. It just becomes more a tracking mechanism, right? So it's you know what an audit looks like. So in this instance, it becomes specifically tracking where you're spending your money and being able to support it. The use of funds, it did change for the 8 week period, and it is for that 8 week period, it is our understanding it's still 75% of the loan has to be spent, or proceeds have to be spent on payroll. That's the intent, that's the purpose. And the other 25% can be spent on non-payroll items. That did change, right? Or it's potentially changed if you accept the 24 week period, meaning that becomes more of a 60-40 split. Again, 60% needs to be spent on payroll, and if you don't, if it becomes 50%, then that forgiveness gets reduced a little bit on that. There becomes an adjustment for FTEs, it becomes adjustment for salary reductions. I mean, all those things are become a little bit more strategic in nature that you have to consider. But maximum, if everything is the same period over period and your payroll went up, then forgiveness shouldn't be an issue. But as changes have occurred in the business, as construction sites have reduced and contracts have reduced, it's likely or possibly that your volume of work has reduced, and you don't have the same number of employees. So there becomes changes to consider. Lastly, there's the good faith borrowing, and we'll cover this a little bit more in detail a little bit. But when the application was filed for forgiveness, or application was filed to obtain the loan, there is a good faith certification where you self-certified or an individual borrower self-certified to say that you had a real need or you thought you had a real need. And so there does become a point where you have to potentially have to justify that with the reasoning, and there becomes a documentation aspect to that. So the application timeline on the forgiveness side, and it is, I thought, a little bit of a lengthy process. It's once you apply for forgiveness, you know, and if you applied on week 20 or week 8, if you're still in that 8-week period. So on day 57, you file the application for forgiveness and you've got all your support. The lender has 60 days to approve it for forgiveness. So we'll say they wait to day 59, they approve it and they send it to the SBA. The SBA then gets it and they're reviewing it for whatever they're reviewing it for, right? So the support, the detail, the whatever. They have 90 days to review it. And so honestly, that 90 days could extend. They could push questions back to the bank, who's going to push questions back to the borrower. And so really we'll say the maximum minimum days this could take is 150 days after application. So the process of forgiveness isn't necessarily super quick. And I will say, I believe the larger the loan, the higher the review, the greater the level of review, both by the bank and by the SBA. In addition to that, the PPP documentation needs to be maintained for at least 6 years after the date of the loan is forgiven or paid in full. And so it's maintaining that information because, and again, we'll talk about this a little bit more in detail in a minute, the SBA reserves the right to review or audit these loans and the documentation and the certifications up to 6 years after this date. If it's more than $2 million, you're pretty much certified that it's going to happen in some sort of review. So maintaining that documentation is critical. I think some questions come, what if I sell the business? Good question. I don't know, right? So I think that information probably needs to be passed along just like you would everything else. It needs to be passed along as well. This is a great slide that Jonna created, and I'm going to let her kind of talk through it.
Yeah, I think probably, and some of the questions coming through, it might be pretty helpful for this illustration to be discussed. The Flexibility Act that was signed on June 5th was good news because quite a few borrowers were finding that they were having to do, you know, a little bit of some machinations to get all of their payroll costs squeezed into 8 weeks because, as everyone knows, the calculation for the application originally covered 10 weeks of payroll. And while they said you can just use 75% and 25% for other areas, many borrowers found that they didn't really have a lot of rent or interest or utilities to cover the other 25%. So the 24 weeks was good news in that regard, and also for businesses that just weren't able to really become fully open. What we don't know about the difference between the 8 weeks and the 24 weeks, what we don't know definitively, is how that will really work in terms of the application. We expect to get another application that has been updated from the prior SBA PPP forgiveness application that should probably answer a lot of our questions. But among the questions we get are, and we have one right here, is there any reason why I wouldn't just keep going past the 8 weeks and use my 24 weeks to cover my payroll cost? Or vice versa. We get questions sometimes, you know, I can get this done in 8 weeks, but I'm a little concerned maybe about my full-time equivalent. How would I make that work if I want to use the December 31st date, but I don't want to keep paying people from week 8 all the way through week 24? So there's still a lot that remains to be seen. I would say the most common assumption is that if you were to complete using the funds that were borrowed at some point between 8 and 24 weeks, that you will likely, but we don't know for sure, be able to go ahead and apply for forgiveness at that point and calculate your full-time equivalents from that date for any kind of reduction, and also the salary and wage reduction. But this is going to take some guidance. As the Flexibility Act came through, the first thing we noticed was that a strict reading of the Act, and it's illustrated here, says that payroll cost must be at least 60% for any of the loan to be forgiven. That was, from my understanding, with Senator Rubio, who expressed some type of feeling on the subject, which was, if we're going to extend the time, we want people to at least use this for 60% payroll, because after all, that is the goal, keeping businesses going, but keeping people paid so that the glut doesn't end up on the unemployment rolls. Well, that we understood that originally from the strict reading that was a bit of a cliff. So therefore, if you had not used at least 60%, the whole loan would be unforgiven. But within a matter of days after hearing that interpretation, some murmurs have come out, some rumors have come out that wasn't the intention. And so we expect, for instance, some change in that area. So while we'll give you the best idea of what we think the situation is now, there's some things that will change. Another area that really helps, I think, is the additional full-time equivalent exceptions. If you fired someone, or someone retired, or someone resigned, that never was going to count against you, even in the pre-Flexibility Act days. But just knowing that the condition of our country has really not returned to normal, Congress and Senate and the President added another couple of exceptions. And that would be, perhaps you can't find an employee that will work for your business. You're trying to hire someone, but there isn't anyone that can do the job. And you would have to, of course, substantiate that. And then also, perhaps your business is really unable to restore full operations. That's a very gray area. At what point do you say, I'm not really at full operations? How do you define that? How do you substantiate that? Again, guidance is definitely needed in that area so that borrowers can meet that requirement and hopefully have those additional exceptions. We've heard quite a few of our clients mention that their employees were let go, or laid off, I should say, perhaps furloughed, and started collecting unemployment. And then when they got the loan, they tried to hire them back, and the employees don't want to come back. Being able to substantiate that you've made a good faith effort in that area may be one of the ways that you can have a full-time equivalent exception.
All right, so we've identified, I'm going to say 4 or 5, because I'm not remembering off the top of my head here, but 4 or 5 areas that we'll say a little bit gray, which we need a little bit more interpretation on. The first one has changed, so it's less gray than it used to be. And so it's PPP, the Flexibility Act changes amount of loan needed for payroll from 75% to 60%. So it will help borrowers. It is helpful for borrowers who have rent, mortgage interest, utilities payment that haven't been able to fully reopen. The gray area in that previously, and it still kind of is a little bit, is on that strict reading of that 60% is it's a cliff. But we received some indication recently that that's not the intention. So maybe it is still a little gray, but it seems to be leaning more towards it's just going to be prorated as far as the forgiveness potentially. Second one is on PPPFA extends time period to use funds from 8 to 24 weeks. And so the borrower does have the ability to elect to have the covered period of loan remain at 8 weeks if they choose to. I do believe that's as of a certain date. When loans are past a certain date, I think that option goes away. But the gray area is determining what time period is most beneficial to the borrower, right? So a lot of businesses, the original understanding was 8 weeks. So you're spending all you can, you're pulling as much payroll as you can into that 8-week period to get it out. But now that that's changed and you haven't used it, what really is the best usage of that time period and that money? So it's the subjectivity really kind of goes to the borrower. Rehire date, it's as of December 31st. The question really becomes, or our concern is, what if the borrower meets that safe harbor any time prior to December 31st? It can qualify for forgiveness. That seems to be the read. But what if it meets the requirement on July 15th and then doesn't meet it on August 1st? So what is that date? Is it truly December 31st, or is it at any point in time? And if it's at any point in time, maybe you do a hire back from a safe harbor side as of that last pay period that you're seeking forgiveness for to get your FTEs back to where they were originally. So there does become a little bit of complexity there, or maybe gamesmanship, or whatever you want to say, and saying what's the right time to bring people back, even if it's just for a short period of time. And those are tough questions to answer. John covered this a little bit, but easing of rehiring requirements. And really this comes down to, oil and gas, all areas have been impacted to a degree. The guidance seems to be more specific compliance based on the requirements established by HHS, CDC, OSHA, and others, right? So there may be some businesses impacted, but maybe not directly related to what the CDC or OSHA is saying, right? So maybe it is a business. I'm sorry, I got distracted here by a squirrel right outside my window, so I apologize. it may be a business that's indirectly impacted, but the impact is still the same. So while some borrowers can clearly be able to meet the requirement, for others, it requires a little bit of subjectivity that could make reliance on provision a bit risky, right? Because it's not direct. A restaurant is very easy. You've been shut down, you can only operate at 25% and then 50%. It's very easy to quantify because you're required to be closed down potentially, right? So, but a construction company, you're considered essential. And yet there may be some impacts of people not wanting you out building because they're not sure about their future cash flows. Is that direct or is it indirect? So there does become a little bit more subjectivity there. Repayment term, that sounds great. You're going to move from 2 years to 5 years. But when the original loan was signed by borrowers, and we saw more than a handful of loan applications, because we did assist as a firm, some banks processing some of the applications to make sure that borrowers qualified. So we saw it from a banking side, from just an assistance standpoint. But those loans were for 2 years, and it's defined as 2 years. So when it changed from 2 to 5 years, that requires basically renegotiation, is our understanding, between you and the bank, the borrower and the bank. And so moving that may make sense for you, but it may not make sense for the bank, because the extension of payment terms means that that bank has to service that loan for an additional 3 years, and they're not getting any increased fees or cost. And so that does become a point of negotiation, I would think. So with the application, the loan forgiveness application, and there's some links to the application as it currently stands, but moving from the 8 to 24 weeks in the Flexibility Act, there will have to be a new application that comes out. Now, when this happened previously, when guidance was provided, there was a lot of questions, and then the application for forgiveness came out. It answered a lot of questions, and it was very good. The application is pretty easy to follow for the most part. There's still room for interpretation, but it's pretty easy to follow. We suspect the same thing when the new application comes out. And I wouldn't say it's any day, but I would say within the next week or two, that application will come out. And so with that, there'll be a lot of answers made. All right, so if we move on to the audit forgiveness preparation, it really comes down to record keeping. And just like when you prepare for an audit, or if you have staff working for you that prepares an account reconciliation, the cleanness of that document and that cleanness of that package really matters from a review standpoint. And so some of the things to provide that they're going to be requested to you to provide are payroll tax reports, maybe Form 941s and other payroll tax reports. It's those gross wages for that 8 to 24 week period. We don't have 24 on here, but it's those gross wages for that 8 to 24 week period. State and local employer taxes, average FTEs. It's just very clean. Any number that's going into the report needs to be supported. And I'm going to say this as a recovering auditor, and John will agree with me as a recovering tax person, it's not in handwritten form, so don't do that, right? So it's not writing 2 numbers on a sticky note and kind of accumulating it. It's providing reports from ADP, it's providing reports from your payroll provider, it's providing tax reports, and it's ticking and tying, back and forth, and making it very clean and understandable and supportable. And again, for the employee side, it is at an employee level. We get a lot of questions kind of on this forgiveness side around employees and such, but so that deliberate bookkeeping and record keeping is very important. I have gotten some questions. Well, what if they're going to compare this payroll period to prior year or 2019? My understanding is the focus is very defined to that 8 or 24 week period. They're not performing an audit of your financials. They're not necessarily questioning why you're spending so much on payroll this year versus last year. It is a very narrow scope to that 8 week period. Can you support, or a 24 week period, can you support the expenses that you have for that 8 to 24 week period? And it is providing mortgage payments, and it's providing those statements, and it's potentially providing the agreements to show that that agreement was prior to February 15th. So I think it's pretty critical there. So it is very narrow in scope to that 8 to 24 week period.
Before you go to the next slide, I was going to add that, we internally do this actual preparation for some clients, particularly for some clients that have very large PPP loans, over 2 million, so they're concerned. One of the things that they were very excited to hear was that the 24-week extension allowed them to now just perhaps focus on payroll. And that may be the case for some people listening today, where being able to pull in additional documentation. You know, we had a question earlier about would equipment leasing be considered forgivable? And we do understand that it's either real or personal property with an agreement in place before February 15th. Assuming that all takes place, that should be a forgivable expense. However, if you have an extended period and you could just use all of the money for payroll, it could possibly simplify your application where you're just pulling payroll reports. And I work a lot with ADP, and they're developing some pretty good reports, Paychecks, some of the other payroll providers, in an effort to try to provide really good support documentation for your numbers. By the way, speaking of employees, another question that we had related to the inclusion of leased direct labor on the full-time equivalent calculation. I think the question is probably related to people that have, you know, a PEO of where their employees were, and I'm assuming that that was as well the state of your situation as well during the application, and there would be no reason that you wouldn't be able to still include them. And the other payroll question I thought I would just hit before we move on was about a semi-monthly payroll period. And for the alternate covered period, if you're semi-monthly, so it's the first and the last day of the month, our understanding is you can't use the alternate covered period because you have to pay every 2 weeks or more frequently, and that would be just greater than that. So I'm assuming that based on the current guidance, you would not be able to use the alternative covered period. Oh, a couple more if you don't mind, Kevin. Calculating the 401k match weekly through the payroll system, but don't actually pay it. Can we include it as an expense? I think you're going to have to actually make the payment. Kevin, would you agree? Yeah,
it's a combination of the accrual and the funding. So it may be that you fund slightly after that 8 or 24-week period, but it needs to be directly related to, you know, that. Mm-hmm. So it needs to be shortly, and it needs to be able to be proven out.
And when we do this calculation for some of our own clients where we're helping to prepare their packet, that clean packet Kevin was talking about, one of the things we do that might answer one of the questions popping up is we actually determined after a while that some of these clients have hundreds of employees, and that the full-time equivalent calculation, it's pretty mathy, and that the best way to do it, especially when people pay it every week, which this was actually a construction client that comes to mind, that the best way to do that was to take each payroll period every week, find the hours, and then calculate the full-time equivalents for that week and just kind of go week by week. That was really the simplest because it's just easiest to look at your payroll in that manner. So hopefully that helps answer that question as well.
I would say in most instances, you as an individual or as a business could prepare this forgiveness package without any assistance. I don't think it's necessarily needed. Maybe there's some interpretation where you want to reach out to your CPA or accountant or banker to get some guidance, but generally speaking, it is doable. Now, when you get to 200, 300, 400, 500 employees, or maybe there's some other complexities, that might be the time to consider reaching out to somebody you trust to assist you.
I'm going to jump in again. A couple more questions. What if you have a semi-monthly payroll and a weekly payroll? Well, then it just got really complicated. I don't think you could use the alternative period in that case because you have the semi-monthly, and I think that all your payroll would have to be on the same cycle in order to utilize that. But the full-time equivalents, technically, and if you look at the application, it says the average full-time equivalents per month. So you should be able to take them per pay period and accumulate that in a month rate, but it is going to be a difficult computation. We've had a couple clients in that situation as well.
I think we just got a few more slides here, and then we'll kind of address the remaining questions at the end for whatever remaining time we have. But as it relates to the SBA review, the Treasury came out about a month ago, I want to say it is, and said that any loan in excess of $2 million is subject to automatic review. And really that allows for up to 6 years of that review. There was some, I think it was the Los Angeles Lakers, it was Ruth's Chris Steakhouse, although they're franchisees, so I'm sympathetic to those guys. I think Harvard, as well as some others, were some big names, and some Houston public companies were kind of even in that as well. And so because it was a little bit of a reaction to kind of tamper down to make sure that this money is getting to the right people, the right businesses. So all borrowers really have the potential to be reviewed, but those greater than $2 million will be automatically reviewed. And really where that scrutiny is going to come down to is really around the necessity of the loan. And I think there's a fair amount of interpretation there of what that really means. It's the access to liquidity, it's the access to capital. But there's a, you know, if it doesn't hurt the business, well, what does that really mean? Don't really know, right? And so it's, there's definitely a gray area there. The calculation of payroll costs to determine the loan amount, use of proceeds, and the forgiveness adjustments kind of go along with that. Separate from this, and kind of what I meant to cover just a few minutes ago, we've had a few clients reach out to us, said they had an error in their initial calculation for the loan. And so they included some things they shouldn't have included in or whatever, and they recognize that after the loan was funded. And so the question is, do we let the SBA know? Do we let the bank know? Do we do something else? And the answer is, we honestly don't know what the right answer is. You know, do you use it on payroll and then ask for forgiveness later? I think all those questions, I think you have to evaluate. I do think honesty is the best policy, and it's just documenting what you did with the funds at that point in time. I will say, due to the rush to the money, and internally we call it was almost like the rush for toilet paper that happened in the market, but and here was just the rush to get funds to protect your business. And so there was a very fast-paced nature early on. And so our understanding at the time was just, if you're filing with the best intents, right? Based on your knowledge at this current time, what is the estimate by which you need to get the funds what you're doing? So all that to say, if you were to borrow more, if there was an error in your initial calculation, it's being able to reconcile that and calling that out, even if it is in your forgiveness package. That's probably the right place to go and do that. So good faith certification, we talked about that just a little bit. It's really comes down to what was the economic uncertainty at that point in time by which you needed to request the loans. You know, maybe you had some cash in the bank, but you didn't know, is that enough cash? The question becomes, maybe you could have accessed borrowing, but it was at an interest rate that was going to be damaging to you. We had a specific client who actually got funding and then turned around and gave it right back because they didn't want to deal with some of this stuff, but he'd never had debt before. He didn't want debt. He was able to fund his business. He got the loan because it was a travel agency business. And so his business went to next to nothing because no one was traveling. But he was concerned because he had cash in the bank that he could potentially use to kind of stay afloat. But he didn't want to deal with basically the risk of the SBA. I think he was a little bit aggressive or maybe too conservative in his approach. But for him, that's the risk that he didn't want to take. So he returned the funds. But really, borrowers are making a certification in good faith, and they're taking into account current business activity. And this is kind of going back into time, right? With COVID-19 hitting and all the shutdowns and that were occurring nationwide, you know, seems like everyone was working from home and still working from home in some instances. Documentation of those conversations and considerations, whether they be forecasts, whether they be these are your financials before and after, maybe it's internal conversations with your board of directors if you have a board of directors. It's being able to prepare, here was the thought process at that point in time, and being able to defend it. It could be a memo, it could be supporting documents, it could be any number of things, but it's really just kind of a well thought out basis of why. In some instances, it's going to be very easy to prove. Pre-COVID-19, you had this much business, you had a backlog of this amount. During COVID-19, that backlog went to nothing. People stopped paying the receivables, those types of things. They may be very easy to document. And that'll be very straightforward. It's going to be some of those, we just don't know what's going to happen, so we borrow the funds, might be a little bit more challenging. So unnecessary borrowing, undefined, what that means through the PPP may carry criminal consequences, $1 million in fine and up to 30 years in prison. First time we presented this, that scared the bejesus out of a lot of people. And understandably, I think that's a very aggressive response from the Treasury Department and others. But I think they're really just wanting to get the funds and the people who really need it, right? It's not just free money. It's to get to the hands of people who really need it is the intent. So defining what is necessary, there's a vagueness doctrine in legal, and neither Jonna or I are attorneys, but our managing partner is, and so we'll just go with that. And so there's a vagueness doctrine, and basically it's a statute which either it is so vague that two reasonable, intelligent people could look at it and infer a different meaning from it. And I think with the good faith, there's a lot of this in there. You know, there's no defined, measurable interpretation of what need is or what is necessary. So we have to believe, we have to assume, and government doesn't always make sense, but we have to assume that there has to be a good faith in determining what is necessary by the people that are auditing this. So what is the impact on revenues? What was the anticipated impact on revenues? Did your cost of sales go up because the cost of materials went up so high because it was just more challenging to get those items in? Was there economic hardship ahead? Is it provable? Is it just assumed? Is it possible? Right? There was a lot of uncertainty when funds were borrowed. It's just really kind of documenting the process by which you considered what that process was by which you needed the funds. And so there is some protection under this vagueness doctrine and some litigation and activity in the past in the courts to help defend your actions if there was good faith in pursuing. That really kind of wraps it up. We have, on this slide, and we have it, we want to be a resource, right? And so we've done a lot of these presentations. We've had a lot of conversation with prospects, non-clients, just to assist and provide some goodwill to the community at large, just to be of assistance. And today is really the same thing. We want to be a resource to you. We don't want to replace your CPA, your accountant, anybody. I know there's several CPA firms that have sponsored CFMA and others, and we want to support them as well because we're all in this together. But we do want to be a resource for you. And so each of these boxes, and we'll send this link out or this deck out after the presentation so you can have in your hands. And each of those boxes there have links by which you can go to and get additional information from our interpretation and our perspective. We've gone to a lot of our competitors' websites, our peers' websites, and just kind of gotten information from them as well. And again, we want to be a resource to them just like I think they want to be a resource to us. So there's a ton of information out there. And we're providing our perspective well, and I think we've helped more than a few people, and that's a good thing. But with that, John, is there any more questions we need to address or
Yeah, I think maybe it would be, if we can do it quickly, one of the questions was, does firing someone for cause include termination for poor performance? And I would say yes, that's a fair firing someone for cause scenario. The date that the lender has to have the forgiveness form, that's a great question, and one that when I was preparing slides for a previous presentation, I was surprised I could not find anywhere when your covered period is over, how many days do you have to put your information together and give to your bank? I couldn't find any definitive answer. Kevin, have you seen anything on that yourself?
Can you say that again?
After the covered period is over and the borrower is ready to apply, how much time do they have to actually submit the application? We know how long the bank has to review and the SBA, but the timeline between finishing your covered period, whatever it happens to be, and submitting, I haven't found any authoritative guidance.
It's undefined. It's just undefined. I would assume, it kind of goes into that 60-day review period by the bank, but that's just my inference versus anything. There's nothing definitive at this point in time.
And then we have another, are you saying that if you have an agreement in place, like Comcast outsourced IT before February, it would be considered forgivable? And yeah, in those non-payroll costs, you definitely want to have an agreement in place prior to February 15th, not a new agreement. When and how do you recognize the difference between booking the loan proceeds as a loan or revenue? Where does it go on the balance sheet? And can you recognize it as forgiven when the bank approves it, or do you have to wait for SBA?
My opinion as a former auditor and understanding of GAAP would be that you would record that loan as soon as you receive it. So it's, the loan date is and the funding date, you would record that as debt, and you would take the cash in and you would spend it just like you'd normally spend it. When you apply for forgiveness, I think once the forgiveness is made by the SBA, right, and it's forgiven by the bank, I think based on that, you recognize, you get rid of the debt or the portion of the debt that was forgiven, and it's basically a recognition of a gain, and it would be below the line, so it's below net, and it's kind of at the lower level of the income statement, that other income and expense, but it would be a gain on forgiveness of debt, and then anything that would remain would just be continued to pay it over that 2 to 5 year period. Now, for that gain, it is not a gain for the purposes of tax purposes, right? They're not treating that as taxable income for that forgiveness. They're treating, and so that that is a reconciling item between your books and between your tax return.
Yeah, so the follow-up question, will the loan be taxable? No, I don't think the loan will be taxable. I think the bigger question is, will the expenses that you paid using the loan be allowed to be considered expenses for tax purposes, or will they be sort of like the entertainment expense that went away in the Trump's recent tax law? We don't know. We've had two theories on that. The IRS certainly wants to make it taxable. So in a way, they want to take away your ability to claim those expenses, but the final word I have not heard on that. Hey, I think the last question then is, it just says, including long-term contract employees and full-time equivalent. Long-term contract employees?
Well, contract employees, if they're truly contract employees, 1099 employees, they would not be included.
Yeah, that wouldn't technically be an employee, right? Right. Yeah, a contract labor, if that's the question, this is an anonymous attendee, but if you're talking about contract labor, then they would not be included. I think that's everything.
Well, very good. Well, Sanella, thank you so much for the opportunity to present. If anyone has any questions, we are more than happy to have a conversation or longer than a conversation, if not in person, unfortunately. But it's been a pleasure presenting to you. I believe CP credit will be coming through CFMA. And I don't know if Sanella, if you have any kind of wrap-up comments or thoughts, but turn it over to you.
I just want to thank you again for a wonderful and very insightful presentation. I thoroughly enjoyed it, and I'm sure all our participants did as well. This is just a wealth of information on a very confusing and vague issue. So I think this really helps us understand this a lot better. So thank you again, and we will see everyone at our next event.
Perfect. Thank you all so much.
Thank you.